Welcome to Delphos Insights. This is episode 29, where we examine how governments can build bankable project pipelines to meet development finance expectations for capital mobilization. In today's capital environment, capital is not scarce, but bankable projects are. Institutional liquidity is growing, yet deployment in emerging markets remains constrained by weak project preparation and lack of alignment with DFI standards. For investors, capital allocation is increasingly determined by readiness, risk structuring, and governance discipline.
Right, and I think that opening statement really sets the baseline for everything we're talking about today.
It really does. I mean, just think about this for a moment. The world is basically swimming in capital right now.
Exactly. You have hundreds of billions of dollars out there actively looking for a home.
But the irony is, in the emerging markets that actually need it the most, that money is just sitting on the sidelines.
Just sitting there.
Right. So whether you are managing capital as an institutional investor, operating as a CFO, navigating private equity, maybe directing a sovereign wealth fund, or even working directly within a DFI, understanding this landscape is just critical.
It is absolutely critical to any strategic objective right now.
Exactly. So the mission of our deep dive today into the collective Delphos research is to clarify exactly why this persistent gap exists. We have this massive global capital availability on one side.
And then this highly constrained actual deployment on the other.
Right. So to start, we really need to set the stage here.
Yeah.
Why are development finance institutions, DFIs, prioritizing private capital mobilization so aggressively right now?
Well, the short answer is necessity. I mean, the current global infrastructure requirements, they just far exceed the balance sheet capacity of traditional public financing.
Right, the multilateral development banks just cannot fund it all themselves.
Exactly. So bankability becomes the absolute driver of investment decisions. Look, if a project cannot attract private commercial capital, it simply will not be built.
Which means this shift is immediately relevant for risk, governance, and investment committees.
Yes, because they are no longer just evaluating a project to see if it has a nice developmental impact. They are rigorously evaluating the risk structuring. They are checking the readiness against very strict international financing standards.
Right, and that brings us to the structural shift we are seeing, because multilateral development banks, MDBs, and their private sector arms like the IFC are undergoing this massive reorientation of their core mandates.
They are, yes. The focus has decisively moved away from just purely direct lending.
Okay, let's unpack this, because I think an analogy helps here. If we look at traditional direct lending, it's basically like building a single bridge.
Right.
An institution has a fixed amount of capital and it constructs one asset.
Yeah.
But this new mandate, crowding in private investment, is entirely different.
It is a completely different model.
Right. It is like building the financial scaffolding that allows private markets to construct the entire highway system. The institution provides the structural support, and that enables vast amounts of private capital to flow safely.
And the mechanics of that financial scaffolding are just fascinating, because this shift relies on very specific instruments.
Like guarantees, right?
Guarantees, exactly. And blended finance structures. Historically, MDBs viewed private capital mobilization as, well, sort of a secondary objective.
A nice-to-have byproduct.
Exactly.
Yeah.
But that is no longer the case. Mobilization is now the primary indicator of institutional performance.
So they are literally graded on their ability to crowd in private investors.
Yes, and they achieve that through blended finance, which basically means combining public or philanthropic funds that can absorb those initial layers of risk with private commercial capital.
Capital that requires strict market returns.
Right. It creates a financial cushion that commercial financiers just cannot manufacture on their own.
So since the institutions have shifted their mandates so completely, we have to look at the data. We need to see what actual deployment looks like on the ground.
We do.
Because when you look at the macro picture, the figures are huge. We are tracking a $380 billion global total.
Which shows the institutional appetite is definitely there.
Definitely. I mean, between $70 billion and $87.9 billion mobilized in 2023.
And those commitment levels are holding strong.
Right. We saw $56 billion committed in fiscal year 2024. And looking at regional banks, we have 16.6 billion euros from EBRD with 58% green.
So the top-line data is incredibly robust.
It is.
But, and this is the critical part, it masks a severe bottleneck when we actually look at emerging economies.
Right, the ground reality.
Exactly. We have to contrast those massive global figures with the localized data. In lower middle-income countries, we see only 0.2% of GDP private participation.
Wait, 0.2%?
0.2%. And alongside that, there's approximately 30% DFI involvement in the infrastructure that actually does get built.
Let me just pause on that for you, the listener, because that contrast is staggering. We are talking about nearly $400 billion globally, yet in lower middle income countries, private participation is at 0.2% of GDP. That is basically a rounding error.
It really is. The spectrum of capital available globally is demonstrably broad. The money is there.
But the readiness is not.
Exactly. Systemic readiness gaps are severely limiting scale. The primary constraint preventing that capital from flowing is strictly the bankability and the readiness status of the public project pipelines.
But hold on, this brings up a really interesting tension in the market.
How so?
Well, if the capital is there and DFIs want to deploy it, why are so many projects rejected by private investors? I mean, governments in emerging markets often present these massive deal lists, right? Roads, power grids, things they desperately need.
Right, they do.
So why do private investors dismiss that? I mean, what is the actual difference between the deal lists governments present and a truly credible pipeline?
Well, the difference between a deal list and a credible pipeline is basically the difference between a rough idea and a commercially viable asset.
I see.
You know, private investors, they do not operate on political timelines. They operate strictly on investment committee-driven decisions.
Right. The IC is the ultimate gatekeeper.
Exactly. Imagine a minister hands an institutional investor a 20-page pitch deck for a new seaport. It outlines the geographic benefits, the economic potential.
But it has no geotechnical survey.
Exactly. No geotechnical survey, no detailed revenue model, no environmental clearances. An investment committee will categorically reject that.
Because it is commercially unvetted.
Right. And actually, presenting lists like that undermines a government's credibility in the markets. These committees demand a strategically curated portfolio that strictly meets international financing standards.
So a true pipeline needs material progress. Feasibility studies, stakeholder engagement, risk allocation frameworks.
Without that foundational work, securing senior debt or commercial investment is essentially impossible.
It sounds like getting past an investment committee is, well, it is less like pitching a good idea and more like passing a rigorous building inspection before you can even buy the materials.
That is a great way to put it. And that inspection basically comes down to three distinct pillars of readiness.
Right. Technical completeness, financial modeling rigor, and ESG compliance.
Let's take technical completeness first. That requires a detailed work breakdown structure.
Something that supports credible cost and timeline projections?
Yes. It demands professional project management right from inception. Detailed engineering designs, supply chain logistics, you name it.
And then the financial modeling rigor, I assume that means the project can mathematically withstand uncertainties.
Exactly. Things like currency fluctuations or supply chain disruptions. The model has to hold up under stress.
Right. And then there is the third pillar, ESG compliance, which I know is no longer just a peripheral concern.
Not at all. It is central to the viability of the asset.
But let me play devil's advocate here for a second.
Sure.
Isn't applying strict ESG compliance to emerging markets creating sort of an unfair barrier? I mean, for countries that just need basic power generation, why burden them with stringent reporting?
I hear that a lot, but it really misunderstands the function of ESG in project finance. This is not about imposing luxury standards.
It is about risk mitigation.
Pure risk mitigation. Look at a power plant. If it displaces local communities without proper engagement and compensation, it will inevitably face protests.
Right.
Protests lead to construction delays, delays lead to cost overruns, and cost overruns ultimately threaten debt repayment.
So institutional investors require ESG compliance simply because it protects the cash flow.
Exactly. Plus, pension funds and similar investors operate with strict fiduciary duties. They often lack the internal resources to assess complex sovereign risks on their own.
So they rely on DFI validation.
They absolutely rely on MDB due diligence. The MDB acts as the validator of the project's readiness.
And if a project is fragmented and lacks that validation, it is dead on arrival at the investment committee.
It will not survive the review.
Okay, here's where it gets really interesting. Do these pipelines meet investment-grade bankability, governance, and risk structuring requirements?
That is exactly the definitive question every single investment committee asks.
And how do project sponsors ensure the answer is yes?
By applying a highly specific financial toolkit. To meet those requirements, DFIs deploy guarantees, blended finance, and credit enhancement.
Let's talk about guarantees, because those seem critical for managing risk.
They are arguably the most critical instrument.
Basically, it acts like an insurance policy for the private investor, right? Say a government signs a power purchase agreement for a solar facility, but then defaults on the payments.
Right. In that scenario, the DFI steps in to cover the loss.
So the commercial bank is not actually taking on the sovereign risk of that developing nation?
Exactly. They are taking on the institutional risk of the DFI, which obviously carries a much higher credit rating.
Which fundamentally lowers the risk premium and mobilizes the capital.
Precisely. And look at the multiplier effect here. Guarantees represent only about 5% of MDB finance, but they mobilize nearly half of all private capital in these markets.
That is incredible leverage.
It is. I mean, the World Bank's Multilateral Investment Guarantee Agency issued $8.2 billion in guarantees in a single fiscal year.
Right, and the Asian Development Bank relies heavily on credit enhancement to support its $2.6 billion in private sector commitments.
Exactly. These tools allow commercial capital to enter sectors like renewable energy or water infrastructure that would otherwise be way too risky.
But a guarantee alone does not just automatically get the capital deployed. The underlying project still has to pass those investment filters.
Yes, the non-negotiable filters.
All right, so if you are listening to this and you are looking at an emerging market portfolio, your first question shouldn't just be about the yield. It has to be whether the asset has passed these specific filters.
Filters like rigorous governance discipline, precise risk pricing,
Strict ESG compliance, structuring quality.
and ultimate pipeline readiness. But there is another major component here that is becoming increasingly important: operational resilience.
Right, specifically regarding cybersecurity due diligence?
Yes. For critical infrastructure, demonstrating operational resilience through cybersecurity is a fundamental requirement now.
I want to expand on that because some people might wonder, why does a pension fund in New York care about the operational technology of a water facility halfway across the world?
Well, because cyber threats have evolved. They are not just data breaches anymore, they are physical operational disruptions.
Right, like a ransomware attack on a natural gas pipeline.
Exactly. If an attack shuts down the industrial control systems, it stops the physical flow of the resource. If the resource stops flowing, the revenue stops flowing.
And if the revenue stops, the debt covenants are breached.
Exactly. So an investment committee views cybersecurity as a severe financial risk, not just an IT issue. Project sponsors have to integrate robust cybersecurity frameworks from day one.
Without that, even projects with high developmental impact just fail to secure capital.
They do.
So, having defined the exact requirements, the financial tools, and these rigorous filters, we really need to look at the practical implications. So what does this all mean?
It means the standards for entry have permanently shifted. Guarantees, advanced risk allocation, ESG compliance, these are no longer attractive enhancements to a pitch.
They're absolute entry requirements.
Right. If a project does not possess these elements, it does not even enter the conversation for commercial capital.
So, governments and project sponsors need a completely new strategic action plan. They have to institutionalize this preparation discipline.
Yes, and that involves some very concrete steps.
Yes.
First, governments must establish centralized units.
Units with a mandate to enforce bankability standards across all public infrastructure initiatives.
Exactly. These units have to act as a clearinghouse. They ensure compliance with national regulations and international financing standards before external investors ever see the project.
So no more fragmented ministries pitching half-baked ideas independently.
Right. And second, sponsors must integrate DFI readiness criteria into the earliest possible stages of the project cycle.
You cannot just slap it on at the end to satisfy a lender.
No, it has to be there from the pre-feasibility studies, addressing commercial viability, risk allocation, ESG impacts, right from the very first design meeting.
And third, I imagine executing this level of preparation requires bringing in some serious expertise.
It requires securing expert advisory support for complex structuring. Governments really have to invest in building capacity to navigate blended finance models.
Right, structuring those transactions to target philanthropic capital to de-risk specific tranches.
Exactly. And that advisory support is also necessary for those complex operational resilience requirements, like the cybersecurity due diligence we mentioned.
It really is a complete paradigm shift in how infrastructure is developed.
It is.
Well, to summarize our deep dive into this research today, the persistent gap between global liquidity and emerging market deployment, it is clearly not a failure of capital availability.
No, money is there.
It is a failure of project readiness. The data shows us that multilateral institutions are highly motivated to mobilize private capital, but investor behavior is strictly dictated by investment committee parameters.
Right.
Capital allocation today requires meticulous readiness, rigorous risk structuring, and unyielding governance discipline. So for you, the listener, whether you are allocating capital, structuring a fund, or advising a government, the takeaway is clear. Early integration of DFI standards is the only proven method to navigate this landscape.
Absolutely. Shifting from conceptual deal lists to systematically de-risked pipelines is just the prerequisite for success now.
It really is.
And as we conclude, I think it is worth considering the broader economic implications here. Global capital markets are becoming increasingly competitive. Liquidity naturally flows toward the most structured, transparent, and de-risked opportunities.
Always.
So it leaves us with a critical question to ponder. What systemic economic risks will developing countries face in the coming decade if they fail to adapt? If they continue to rely on traditional unvetted deal lists rather than institutionalizing this new standard of project preparation discipline?
That is a crucial question to leave on. This has been Delphos Insights. Learn more at delphos.co.